All right, today we are diving deep into a really powerful trend that's starting to reshape how people manage their wealth. It's called direct indexing. Now, it promises more control, a ton more customization, and something every single investor wants: better tax efficiency. So, let's get right into it. But first, let me ask you a question. When you think about your portfolio and its growth over the long haul, are you really factoring in one of the biggest but often hidden drags on your performance? Yeah, I'm talking about taxes. What if there was a way to actively manage that cost instead of just accepting it? And that really brings us to what we can call the investor's hidden cost. You see, for years, the standard ways to invest have had these built-in tax problems that, honestly, most of us just figured was the price of admission. For most of modern investing history, the go-to choices have been mutual funds and, a bit more recently, exchange-traded funds, or ETFs. And look, they're great in a lot of ways. They're convenient, diversified, and easy to access. But they have a hidden flaw, especially when it comes to the taxes you pay. So here's the fundamental problem with a classic mutual fund. It's a pooled vehicle, right? Everyone's money is in the same pot. So when other investors decide to sell their shares for a profit, the fund manager has to sell stocks to pay them out. This creates capital gains. And here's the kicker. Those taxable gains are then distributed to all the investors in the fund, even if your investment hasn't gone up one bit. You're literally paying taxes because of what someone else did. And this isn't some tiny rounding error. According to research from Morningstar, this tax cost averaged about 1.7% per year for U.S. equity mutual funds in the 5 years up to 2020. That is a significant drag on your returns, year after year. It really begs the question, isn't there a better way? Well, the solution lies in an evolution. It's a shift away from just owning a piece of a fund to directly owning the underlying stocks themselves. And that simple change, it turns out, makes all the difference in the world. You can see the whole journey right here. We started with mutual funds way back in the 40s. Then, in the 90s, ETFs came along, offering a much more tax-efficient structure. And now, technology has unlocked the next logical step: direct indexing. It lets you completely bypass the fund wrapper and own the individual stocks of an index, like the S&P 500, directly in your own account. Here's a really simple way to think about it. Owning a fund is kind of like buying a pre-made meal from the store. You get the whole dish, but you have zero control over the ingredients. Direct indexing, on the other hand, is like owning all the raw ingredients yourself. You have total control, and most importantly, the tax bill is yours and yours alone. This is where it gets really good. This direct ownership is the key that unlocks the main benefit of direct indexing: the ability to actively manage your tax bill and generate what the industry calls tax alpha. The magic here is a strategy called tax loss harvesting. Since you own every stock individually, you can strategically sell the specific ones that are down in price to harvest a loss. Then you can use that loss to cancel out capital gains from other winning investments in your portfolio, which can seriously lower your tax bill. That extra value you create, that boost to your after-tax return, that's tax alpha. So what does this actually look like in the real world? Well, this hypothetical scenario from a BKLN investment group paper shows it perfectly. Let's assume everything has the same pre-tax performance. The mutual fund and a standard separately managed account, or SMA, give you a 9.5% after-tax return. The more efficient ETF does a little better at 10%. But now, look at the SMA that actively uses tax loss harvesting, our direct indexing approach. It jumps all the way to an 11.75% after-tax return. That's a potential 1.75% of outperformance over a very similar ETF. And you didn't get that from picking better stocks, you got it from smarter tax management. That is the power of tax alpha. And when you zoom out and look at the long-term effect, wow, it can be profound. A different analysis from Morningstar ran a hypothetical strategy over 23 years. They found that tax loss harvesting could have boosted the final after-tax value of the portfolio by a staggering 28%, compared to just buying and holding the index. But listen, tax savings are only half the story. The other massive advantage of owning the stocks directly is the ability to create a portfolio that is uniquely yours. This is where we get into real mass customization. Because you own all the individual ingredients, you get to tailor the recipe. Maybe you want to exclude fossil fuels or tobacco stocks. Done. You can screen them out. Are you passionate about AI or green energy? You can tilt your portfolio to have more of those. What if you have a huge position in your company's stock? You can build the index around it to stay diversified. You can even do things like optimize your charitable giving. It is a level of personalization that a simple fund just can't touch. This framework from Morgan Stanley does a great job showing where direct indexing really fits into a bigger strategy. Think about efficient markets, like large US stocks, where it's incredibly hard to consistently beat the average return. In those markets, the game really shifts. The focus becomes less about trying to find pre-tax alpha and more about maximizing your after-tax returns. And that's exactly where a passive strategy with powerful tax loss harvesting like direct indexing really shines. So, when you put it all together, the powerful tax management and the deep customization, what does the future look like? Is direct indexing just a niche product for the super wealthy, or is this the new standard for everyone? Well, some analysts are making some very bold predictions. BKLN Investment Group puts it plainly. They think that separate managed accounts, the vehicle used for direct indexing, will eventually overtake both mutual funds and ETFs. I mean, that would be a monumental shift in the entire wealth management industry. Now, of course, it's not perfect. There are always trade-offs. The benefits are crystal clear. Tax alpha, incredible customization, and so much more control. But you have to consider the limitations. Since you're not perfectly matching the index, you can have what's called tracking error. The management fees, while they're coming down, can still be higher than a super cheap ETF. And it's important to know, as your portfolio grows and grows, the opportunities to find and harvest losses might naturally shrink over time. And get this isn't just for stocks anymore. The whole model of direct ownership and tax harvesting is expanding. We're now seeing it being applied to things like municipal bonds, and even to incredibly volatile assets like cryptocurrencies, where the potential for harvesting losses is just enormous. Which leaves us with one final big question. As technology continues to drive down costs and make direct ownership easier and more accessible than ever, are we going to look back at mutual funds and ETFs as just a step along the way? Could a hyper-personalized, tax-optimized portfolio become the new default for every serious investor? This is not financial advice.